My job today is to talk you through the personal tax changes in yesterday's budget. And the first thing really to say is that there really weren't very many changes in terms of personal tax, and certainly nothing that we hadn't already heard. I'm just going to skip through these first 3 slides because they are really just confirming what we already knew, and that is that the personal allowances and the tax bands are unchanged for 2020-21. So the personal allowance still £12,500. The point at which higher rate tax is due is still £50,000, and the point at which you will start to lose your personal allowance is still £100,000. So no changes there. And something else we knew about is the ongoing effect, the changes to the way in which tax relief is given on mortgage interest for buy-to-let properties. Our buy-to-let landlord clients will very much be aware of this. This was a change that was first introduced in the 17-18 tax year, and by the time we get to 6th of April this year, we will have reached a point whereby all of the tax relief on mortgage interest is given at a rate of 20% as a tax reducer. So what we're doing at the moment is very much working with those landlord clients to try and minimise the impact of these changes on them. Something we weren't expecting in yesterday's budget is just a small announcement about the way top slicing relief is calculated on life insurance gains. Now, these are investments where when you cash them in, you receive a chargeable event certificate saying that you've made a certain gain over a number of years. The way in which HMRC were calculating the tax on these gains often led to clients losing their personal allowance. And when you look at the legislation, it's quite clear that really this wasn't intended to happen. So we had some welcome news yesterday in that the way these gains will now be calculated, for a lot of people, it will mean that the personal allowance will be available. So something we will be doing is reviewing situations where clients have had these gains just to make sure that reliefs are available. Something I wanted to do is just have a look at income tax rates and just see how the UK compares to other countries around the world. So what I did was took an example of an individual taxpayer earning £100,000 of employment income. And I just wanted to see how much tax that person would be paying in various different countries. So what we have here is a graph which shows how much tax will be payable in the US, the UK, Ireland, Spain, Italy, Germany and France. The lowest rate of tax is in the US, but this is only the federal tax. So actually, depending on the state that individual lived in, the tax rate may be a little bit higher. But the US, federal tax only, a rate of 18%. The composite rate in the UK, and that's after taking into account the personal allowance and the various different tax bands, that's 28%. In Ireland, 33%. Spain, 36%, Italy, also 36%, Germany, 42%, and France, 44%. So actually, I hope this helps to demonstrate that the UK isn't perhaps as expensive in terms of income tax as people might think. On to capital gains tax now. A change that was introduced, we heard about last budget, but seems to have gone under the radar a little bit, is some changes to the way in which gains on residential property will need to be reported. From the 6th of April this year, where somebody is disposing of a residential property which isn't subject to principal private residence relief in full, that disposal will have to be reported to HMRC within 30 days of completion. Now, normally when we're talking about property disposals, it's the date of exchange, which is a trigger point for capital gains tax. But for these purposes, it's 30 days after completion, and you have to report that disposal to HMRC and pay an estimate of the tax due within that time frame. So what this means is that if you're a 40% taxpayer and you dispose of a property making a gain of £60,000, say, you will need to report that disposal within 30 days and pay the tax. So assuming you're a high rate taxpayer with your full capital gains tax annual exemption of £12,300 available, you will have to pay £13,356 within 30 days of that sale going through. Now, if you make that disposal on the 6th of April, and then on the 7th of April, perhaps you sell a share portfolio and make a capital loss of £20,000, Even though you know about that loss within that 30-day period, you can't take that into account when paying your estimate of capital gains tax. So what you would have to do is wait 12 months until you file your tax return, which will give you the relief on that losses, at which point you would get a refund of £5,600. So the message here really is that it could be a significant cash flow disadvantage for anybody disposing of residential property. Staying with capital gains tax and properties, we have some big changes, particularly with regards to lettings relief, which come into effect from the 6th of April this year. Again, we knew about this in advance, but it's potentially got quite a significant impact for anybody disposing of a property which there's some principal private residence relief on. What lettings relief is it's a relief that exempts part of the gain where you have a property where you've lived in it at some point as your only or main residence, and it allows for up to £40,000 of the gain per person to be removed from the charge to capital gains tax. If you've got maximum lettings relief on a property, that's worth £11,200 per person, so £22,400 per couple of capital gains tax. And to put this into context and what these changes mean in the real world, if you were to sell a property today, which is subject to a £200,000 capital gain, you've owned that property for 20 years and had 10 years of actual occupation. Today, the capital gains tax bill on that for a high rate taxpayer would be £15,190. After the 5th of April, that increases to £29,015, so an additional cost of £13,825. The message here, therefore, is if you have a property on which lettings relief may be due, do talk to us, because potentially there might be some steps we can take to help you bank that relief before the 5th of April. On to national insurance. You may have heard the Chancellor stand up yesterday and say that the national insurance threshold is to rise to £9,500. That is true, but it's only for employees, not employers. Previously, there was a big announcement that the national insurance thresholds have been aligned. They have now come out of alignment. So what this means in the real world is if you are a director shareholder on a low salary, high dividend remuneration scheme, your salary is unlikely to increase to £9,500. It's more likely to be £8,788, which is the 2020-21 equivalent of the 8,632 you're probably receiving currently. There's also a new national insurance exemption for veterans. The government are trying to encourage employers to take on veterans. So what they've decided to do to encourage this is to introduce an exemption for employers' national insurance where you're taking on a veteran, and this applies where they're paid up to a maximum of £50,024 per annum. Staying with national insurance, the employment allowance is increasing. It was £3,000, but it's gone up to £4,000, but it's not going to apply to everybody. From the 6th of April 2020, you will only qualify for this allowance if your national insurance liability for the prior year was below £100,000. The government also has a bit of a grudge against one-man band companies, personal service companies, and unfortunately, if you fall into one of those categories, you're not going to qualify for that allowance either. And this last announcement, not going to make a huge amount of difference to a lot of people. In terms of percentage increases, it's a large percentage increase, but in real terms, if you're working from home, you can claim an allowance of £6 a week, up from £4. Staying with remuneration, company cars always used to be a very popular perk, but in recent years, they've very much fallen out of favour. The reason being, they've been quite expensive in terms of tax. And what we see with the government is taxes are used to either drive an increase in revenue or a change in behaviour. What we're seeing here is a push to change behaviour. Electric cars are becoming very efficient to have as company cars. So what I just wanted to do was give you an idea of the difference between what a sort of fairly standard company car might cost you in terms of tax, a high-end car, and an electric car. What you can see on this slide is that if you were to choose a Mondeo, that would cost you £3,461 in tax per annum. A BMW 7 Series, much higher list price, would cost you £10,611. But a Tesla Model S at £82,000, from 6th of April this year, no benefit in kind charge. If you had that car today, there would be a 16% benefit in kind charge based on the list price, but that goes down to 0 from 6th of April and increases to 1% in 2021-22 and 2% in 22-23. So very efficient as a company car. However, if you can't face going entirely electric, a hybrid car might be the way forward. These are taxed based on their electric range. If you have a hybrid car with an electric range of more than 130 miles, no benefit in kind charge. If you have a car that has a maximum range of less than 30 miles, you can see here for a mid-range car, that's going to cost you about £1,680 in tax, and an upper range car with a list price of £70,000, £3,360 in income tax. So the question here really is, would you want a hybrid car and pay £3,400 in tax, or maybe fully electric with no benefit in kind at all from 6th of April? The choice is yours. Fuel and van benefits largely unchanged, but again, we see the push here towards electric vehicles, with the electric van benefit being reduced to 0 from the 6th of April 2021. Now, the last tax that I wanted to talk about today was inheritance tax. And what this slide shows is the amount of inheritance tax paid by region in the UK. And the two segments that I really want to focus on are the red and yellow segments. The red is London and yellow is the South East. So you can see from this slide that in the South East, we are paying the lion's share with London of inheritance tax. And that's good news to some respect, because there is so much that we can do to reduce inheritance tax. I have to say, when watching the budget yesterday, I was really waiting with bated breath for some anticipated changes to IHT, but actually there weren't. Whether there will be changes in the autumn, we don't know, but I suspect there probably will. The only change that we can really talk about, we know about, is the increase in the residence nil rate band, so that's now at the maximum of £175,000. What has been talked about, however, is some wide-sweeping inheritance tax reforms. We are very much expecting business property relief, agricultural property relief, and gifting exemptions to be targeted. Therefore, if you are wanting to make use of any inheritance tax exemptions, now is the time to do it, because we really don't know how much longer we're going to have them for. So the final point I just wanted to make was just about making tax digital. When this was announced by HMRC, it was announced with trumpets and fanfares as a great initiative. Everything was going digital, and then it stalled. We're now in a position where VAT-registered businesses have to use MTD compliant software to file their VAT returns, and we were expecting non-VAT registered businesses and certain landlords to have to register for MTD from the 1st of April 2020. That's now no longer happening, and MTD is very much under review. So in terms of when businesses and individuals will have to register if they aren't already, it's very much a case of watch this space. So in summary, the key messages from today really in respect of personal tax are: talk to us about residential property disposals, because potentially there will be reporting and payment requirements. Again, talk to us if you've got residential property on which lettings relief may be due, to see if we can do something to bank that. Directors' salaries are not likely to have any significant changes made to them. Reviewing company cars, now is a great time, particularly if you're looking at something like an electric car on maybe a three-year deal. And inheritance tax exemptions, I think it's very much a case of use them or potentially risk losing them, because we really don't know how much longer they will be around for. That's it from me. Thank you very much.